LiteFinance, the world of financial freedom.
Good morning, it's Monday, February 28th. If after 2020 someone thought that it would only get better now, there are probably no illusions right now. As for inflation, it could seem that there was a light in the tunnel somewhere, that in the second half of the year the situation will start to return to normal. But after the past week, the forecast for lower energy prices are, to say the least, worrying. Recent data on inventories show how fragile the oil and gas market is. There shouldn't be any significant jumps, but we will wait until the situation returns to normal and then see how the economies will grow, and so the oil demand along with it. So one must expect further increases in gas and oil prices, at least in the medium term. In terms of trading on currency pairs with the Russian ruble, it was halted right after the market opened overnight. And only now you can see any revaluations updates, but the spreads and current fluctuations exclude any entry options. So it would be better to focus on the remaining assets available for trading. Another topic that we need to raise is the fact that while we are watching closely at the opening of the market in the US, and the Chinese stock exchange was already operating, and while the session looked boring from a broader perspective, the shares of companies servicing payments, including the Chinese equivalent of SWIFT, are growing strongly. Shares related to Chinese cross-border interbank payment system CIPS are rising after the Western country's decision on Saturday to exclude some Russian banks from the SWIFT messaging system. Most likely the reason is, as noted by Bloomberg, there is growing speculation that Chinese CIPS may become the alternative to these banks. And so, what is CIPS? It is a payment system that offers its participants clearing and settlement services in cross-border yuan transactions. Indeed, this is the Chinese version of SWIFT that most Russian banks will probably have to adopt soon. And China will probably quickly cope with any threats of sanctions if it accepts Russian banks for itself. It is now clear that instead of driving a wedge between Russia and the country that is truly America's greatest global contender, which is China, the West has managed to bring the two powers even closer together while threatening the fate of the world's reserve currency. The Central Bank of Russia raised interest rates up to 20%, and the government ordered Russian companies to get rid of 80% of their foreign currencies to counter the current situation. You can see from the ruble charts that it is not enough though. Regarding the potential effects to be expected, it all depends on resolving the issue of raw material supplies. However, the common denominator will probably be shifts in the dates of interest rate hikes, either in the US or in the case of the ECB as well. But now let's quickly move on to the charts. So as for oil, I would be looking forward to imply some trades when the price will reach and break levels of $103 to the upside or $96 to the downside. As for gold, the price made one-to-one pattern, and right now I would like to see a pullback towards 50% retracement levels, which is 1870 and 1860 US dollars per ounce, and from there continue the upward move. Next on is GBP USD. Here we have clear harmonic pattern with the point D on 78.6, and the target is on 23.6, which is the price level of 1.3611. So that would be all from my side. Thank you for watching, and till next time guys, bye bye.